Several names in the sector. So joining us now is Andrew Charles from TD Cowen. Andrew, it's great to have you on. Let's start right there. Why are you bringing price targets down on some of these chains?
Great to be with you again, Morgan. So look, at the risk of sounding old, unfortunately, we're looking at Gen Z as a new pocket of softness. Restaurant investors have heard about softness with lower income consumers as well as Hispanic consumers. We're flagging the most incremental and newest right now is Gen Z. And what we're looking at is we can see that youth unemployment is starting to outpace the national average at a faster gap. Obviously, we didn't get the news report this morning on the jobs, but we can see that looking in the last 6 months, we've seen a steady outperformance of youth unemployment, age 16 to 24 versus the national average. You couple that as well with student debt repayment over the last 5 or so months as well, ticking higher, combined as well with consumer confidence that for the youngest generation used to be an outperformer back in 2024 and now is underperforming the national average in 2025. All paints a picture that looks like youth is really leading this downfall, which is really the core customer of these fast casual businesses.
It's interesting because as I look at this report, we keep seeing all of this mixed data, especially where the consumer is concerned. Mixed commentary depending on the consumer-facing company you speak to as well. So the fact that you break this down according to younger consumers, Democratic Party, liberal consumers, low-income consumers, and Hispanic consumers, I find very, very fascinating. What were the results of that?
Yeah, look, I appreciate you flagging that. I would say that, what we're seeing is that fast casual right now is not immune from these broader challenges. Bros remains our favorite, within fast casual, which is Dutch Bros, ticker BROS. We like that this company has been executing and had been the cleanest story of 2025, combined as well with the food rollout they're doing. And elsewhere in the restaurant industry, we also like Domino's Pizza, ticker DPZ, as we think they're poised for a solid quarter and a better outlook on 2026 than investors are expecting. And lastly, First Watch, FWRG, a full-service concept. As we can see within our data, that full-service restaurants, sit-down restaurants, are performing best as they're less exposed to this customer group.
Yeah. How much are the sit-down restaurants taking market share from the fast casual ones?
Yeah, it appears that seems to be the case. It's kind of interesting to see that casual dining, which had been really the share donor over the last roughly 20 years, give or take, for the restaurant industry outside of blips. We're seeing right now there's quite a bit of share gains that they're seeing as investors are favoring casual dining restaurants like First Watch.
Is there a scenario in which some of these companies start to bring their prices down to attract more people back into the stores?
It's an interesting question. We've seen, broadly speaking, fast casual try to take the quick service playbook this year. And what I mean by that is they're focusing more on speed of service, focusing more on advertising, focusing more on menu innovation, all tactics you saw out of quick service. I think we're going to see value done very sensitively because these are premium brands. This isn't their forte as to discount. But we are seeing things like loyalty programs where if you join, there's definitely certain CRM efforts that restaurants are deploying towards loyalty members. They can try to get value that way. I think you're going to see as well more fast casual restaurants really emphasizing the amount of portioning you get and how you can add so many toppings to your dish as well. So I think value is a very slippery slope, but I think fast casual is waking up to the fact they're going to have to promote value more aggressively than they've done.